If you're raising investment for your startup, there's one document that you need to know about: a term sheet. Whether you're in the early stage of your startup growth, negotiating with angel investors, or further down the line and looking to lock in a venture capital firm, having a strong understanding of how term sheets work is important. A term sheet, put simply, is a non-legally binding agreement that lays out the key terms of an investment deal. Think of it as a summary of terms that helps investors and founders get on the same page before spending time and money on full legal contracts. It lays out important things like a company's valuation, how many shares are being sold, how much they're being sold for, who's on the board, and the level of involvement that investors can have. While the term sheet isn't legally binding most of the time, it's still treated as an official document. Once signed, it's generally agreed that neither party can go back and change key terms. And if they do, it's seen as a big breach of trust and it could tear the deal apart. So a term sheet is not like a contract, but it's definitely something to take seriously. One of the main differences between a term sheet and a contract is that a term sheet is not legally binding. However, there are some clauses in there that might be legally enforceable. For example, it might be mentioned that neither party can share the deal terms publicly. If this is broken by either side, the other could take legal action. Another legally binding clause might be exclusivity, or an agreement not to take other offers for a set period of time. In this case, breaking this could have legal implications. The rest of the terms are usually subject to contract, meaning that they only become legally binding when they're written up formally and signed. Think of a term sheet like a pre-contract agreement. You decide what's going in the contract before it's actually drawn up, signed, and is legally binding. For founders, a term sheet isn't just a place to write down the details of a deal. It's also a way to talk through the nitty-gritty and find out what an investor actually wants. A term sheet can be a great way to get a lot of the discussion out of the way before proceeding with the legal process. It means all questions are worked out up front, and it can also help speed up the process later down the line. But most importantly, a term sheet shows real commitment from both sides to go ahead with the deal. It means founders know investors are serious before they start the timely and expensive legal process. While term sheets can vary slightly, there are a few key elements that most of them have, including a valuation, a pre- and post-funding valuation, and this helps to outline how much of the company you're giving away. For example, if your startup is valued at £2 million pre-money and you're raising £500,000, your post-money valuation is £2.5 million and the investor gets 20% equity. Equity: what percentage of the company the investor will own after the deal, and any details around equity arrangements. Sales details: outlining what an investor gets in a sale or wind down. For example, it's common that investors will get a first option to take their money out before other stakeholders are paid, but this usually lays out what would happen if a startup does get sold. Anti-dilution rights: this protects investors from having their share diluted if you decide to raise down the line. Under these terms, investors will also have a set percentage stake in the company, so it may mean giving them more shares to stay at this level later down the line if you raise again, or having a set amount of shares set aside for employees so that their percentage isn't affected. Investor involvement: whether investors have a board seat, rights over key decisions, or the ability to attend key meetings and make big decisions. No shop clause: this stops you from getting other offers once a term sheet is signed. However, there is usually an end date to this. A term sheet is usually written by investors, but founders are also able to write the first version. This means that you can set out the key terms and the tone and work out the finer details later on. Remember, finalizing a term sheet is a collaborative process, so it's not about who starts it, but it's about finishing it together. Once the term sheet is signed, the legal bit commences. Investors are going to want to dig deeper into your legal, financial, and operations data to do their due diligence. Then the legal documents will be drafted based on the term sheet. Once completed, the money is transferred and the real work begins, helping investors get that return. A term sheet is more than just a piece of paper. It's the start of a long-term partnership between founders and investors. Knowing what goes in it, how legally binding it is, and how it might affect your company is really important. And while technically it isn't legally binding as a whole, you should still treat it with the same level of care and attention. After all, a good term sheet will help set you and your investors up for a long collaborative relationship. And who wouldn't want that?